Awesome. Thank you.
Great. Thanks
Yeah, that would be
everybody
great.
for joining us. We're just waiting just one more moment. But I think EJ, if you want to kick us off.
Sure.
Go
Yeah,
ahead.
I will kick us off because we've got so many really great things to talk about. So good morning, everybody. Good afternoon, good evening, depending on where you are. And thanks for joining us. I'm EJ Ashbourne, Executive Director of PQMD. And on behalf of our entire team, I want to warmly welcome you to today's Pillar Talk, Capital for Health, Demystifying Investment Models and Mobilizing Resources for Impact. Big title, big topic. All right, for those of you who are new to PQMD, we're a global alliance for international NGOs and healthcare companies working to ensure sustainable access to quality medicines. We work grounded in six pillars: humanitarian assistance, health system strengthening, disaster response and preparedness, guidelines, knowledge and innovation, and then climate and health. And you'll find all the links to more information in the chat, so please have a look. And before we get started, I also just want to do some quick housekeeping. Please enter your name and organization in the chat so we know who is with us. Keep yourself muted unless invited to speak, but feel free to post questions or comments throughout the session. And today's discussion is being recorded and it will be available on PQMD's Community of Practice later this week. And so you're completely free to share it with your colleagues and others who you think would be interested in listening. So now to today's session. The global health financing landscape is rich with opportunity, but often clouded by complexity. As funding models evolve and new forms of capital emerge, many organizations are asking, how can we effectively engage with the right investors, and what does it really take to make financing models work for health impact? To help unpack that question and much more, we're delighted to be joined by Karen Wilson, founder and CEO of GV Partners. And many of you who were with us in London this past April will recognize her as sort of one of the most popular speakers at our Global Health Policy Forum. So we're really excited to have her with us today. Karen brings a wealth of experience at the intersection of sustainable finance, ESG, and impact investing, bridging the private, public, and academic sectors. She also is a valued member of PQMD's advisory board and serves on multiple international boards focused on impact finance and social investment. So Karen, thank you for leading this important conversation, and thank you for being here with us. And I'm going to hand it over to you to get us started. Thanks so much.
Thank you. Thanks so much, EJ. It's a pleasure to be here with you all. And yeah, it's quite a tall order in terms of the agenda. I have prepared a deck of slides, which I hope are going to be helpful in unpacking some of those things that EJ mentioned. I have a lot more in the slides than I'm planning to cover, because I wanted to give you as much information as I could, but I know we have limited time here. And I want to make sure also that we have a lot of time at the end for Q&A. We have a lot of experts in the room. I've already spotted some. So I reserve the right to cold call them. You know who you are. And anyway, so let me move on if I can move the slides. It seems not. So maybe, oh, there we go. Okay. Okay. That's working. Perfect. Thanks. So the objective today is really to just help raise awareness and knowledge about financing for health. This is the beginning of what I hope will be a continued discussion. It's also to provide a platform for more learning and sharing between the members, because a lot of you have been involved in innovative finance. So we also have a lot to learn from you all. So again, I hope we can get into that in the Q&A. And also, we're hoping to identify areas where we can do a deeper dive on finance at the Global Health Policy Forum in April. So the agenda for today, okay, it doesn't want to move. Riley, can you move it one forward? Okay, there, perfect. Okay, so I'm going to do a short presentation talking about the different kind of investor types and expectations. That's something I've seen in the past PQMD events I've been in, that you know, a lot of people that aren't involved in the investment field think all investors are the same. There's quite a diversity of different types of investors, so we're going to talk about that. Then I'll talk about the different kind of financing models. And as I mentioned, I've put a lot of materials, I put a lot of examples in the deck that you can look at later. I'm not going to go into those examples now. There are also a lot of myths about financing, so we're going to talk about some of those, and then talk about what's working, what's not working. And again, that's where I hope to hear from many of you as well. So, starting with the investor types and expectations. Going to there we go. So the investor landscape. So I understand, because the investor landscape is very confusing. There are a lot of different types of funders that you're all familiar with. Philanthropy, government, different kinds of government, DFIs, MDBs, private investors, a lot of different kind of investors under that, institutional, impact, high net worth individuals, family offices, foundations, and of course, corporates are a big player in the market as well. But in that landscape, we have a lot of silos, unfortunately. We have all of the people that focus on green finance, the people that focus on blended finance, impact investing, development finance. And there's been a big effort. I worked at the OECD leading the work on impact investing a number of years ago. And there's really been an effort to try to bring these communities together, especially at a time like today. We don't need silos. We need to really build upon learning in finance, in development, and applied to different sectors, and not recreate the wheel every time we're looking at a different sector. So, so that said, I'm trying to move to the next slide. There we go. So the spectrum of capital, there's a lot of information on here, but let me just voice over what's here. I talked about the different kinds of expectations that investors have. And this is what we call in the sector is called the spectrum of capital, where on one hand, you have traditional philanthropy. You all know what philanthropy is, where you're giving a grant, you're not expecting any kind of return, but you're hoping to have a lot of impact. On the other end of the spectrum, you have fully commercial investors that are trying to maximize their financial return. They have a fiduciary responsibility to maximize financial return. So those investors are rarely going to be able to invest in anything that goes beyond maximizing financial return. But the good news is we have a big range of different types of investors in between. So on one hand, starting from the philanthropy side, already 20, 25 years ago, this concept of venture philanthropy was developed in Europe and now is spread around the world. And that's philanthropists that are trying to take a venture capital type approach when they're supporting social enterprises and social ventures. So they're not only giving them money, but they're trying to help them become ongoing concerns. So moving a step beyond being a charity that needs a handout every year, but being more viable social businesses. So they want to have some return, but they mostly want to have impact. So even if they don't get all of their capital back, if they can redeploy that capital towards social ventures, then that's a great win for them. Then you have the social investors that want to have both a financial and a social return, but they're willing to have a below market return as long as they can really have that social impact. Then you have this area of impact investors, which has emerged in the last 15, 20 years. They want to have both a social and a financial return, but they definitely need to have that market rate of financial return. And that's why I broke out the social investors and the impact investors. So from the philanthropy side, we've seen increasingly philanthropists that are trying to be more creative about how they can have more lasting impact by supporting socially focused, environmentally health-focused ventures, and also these social investors and impact investors. But also on the mainstream side, again, starting a couple of decades ago, we've seen more mainstream investors, institutional investors, that have started to think about, well, how can we be responsible investors? We don't want to invest in bad things. So that's where we've seen a lot of negative screenings where investors will not invest in certain sectors, and positive screening where they want to invest in, quote, good sectors. And the good news is, of course, the healthcare industry falls in that good sector. So there's a range of these different types of investors out there. They all have a different risk, return, and impact objective. So depending on what kind of project you're looking for financing for, you might be able to be more, attract some more mainstream investors, or you may really need to look at the venture philanthropists, the social investors. So not all investors are the same. They have these very different objectives. And so it's very important to find the right match. There's no use chasing the mainstream institutional investors if you really have something that's more suitable for a social investor. So that's why I wanted to take a minute on this slide. Next slide. So what drives investment decisions? Obviously, investors are going to look at risk and return. They've been doing that for a long time. But now, in the last couple of decades, they're also considering impact. So how much does the impact of what they're investing in align with their own objectives? And of course, there are a lot of influencers as well around investment decisions. That could have to do with policy stability. It could have to do with partnerships, many different things. But at the core is not only risk and return, but risk, return, and impact. Next slide. Next slide. Now what I'd like to do is to go into the different kind of financing models that are out there. And I'm sure you've heard many of these terms before. Maybe you're already familiar with some of them. Maybe you've heard of them, but you have no idea what they mean. So I wanted to step through each of them and give a little bit more background about what they mean, and then show you very briefly an example, which I won't go into in detail. So we're going to go one by one in these, starting with impact investing. And I talked about impact investing on the spectrum of capital. They are really in the middle of the spectrum of capital. So if we go to the next slide, the impact investing market has grown tremendously over the last 10 to 15 years. It's now estimated to be more than $1.5 trillion. But if you look at all of the assets under management globally, this is still a very small part of the market. So, but a very important part of the market, because impact investors want to have both that social, environmental, or health impact alongside having a financial return. Next slide. So what is the role of impact investing? To me, well, first of all, we need new models to fund, deliver, and scale innovative solutions on the ground. So a lot of people think it's about the money. It's not so much about the money as it is about bringing new approaches to what's being done on the ground. What are the different kind of solutions that are more effective, more efficient? And so it's bringing impact investing helps to bring a private sector mindset into looking at some of these solutions on the ground and helping to develop solutions in partnership with the service providers that are more effective and more efficient. So what I think is really important about impact investing is that notion of innovation, bringing innovation to those solutions on the ground. Also with impact investing, there is accountability, because if you say that you're investing for impact, you need to be able to demonstrate that. So you need to be measuring the impact that you're having. Frankly, I think all investors and companies should measure their impact, positive and negative. But certainly if you're claiming to have an impact, you need to be able to measure the impact that you're having. And also what I like about impact investing and also venture philanthropy and social investment is that it's really encouraging these social purpose organizations to develop business models that can help them be sustainable, where they don't have to chase after grants year after year, but they can really focus on the great work that they're doing on the ground. Next slide. So if we look at the sectors that impact investors are investing in, and I know there's a lot of information on this slide, I wanted to highlight where healthcare falls in impact investing. So on one side of this graph, it's showing the assets under management that have an allocation for this sector. And on the other side, you can see the percentage of respondents to the survey. Anyway, when you sort through this, the main sectors that more mainstream impact investors are investing in: energy, financial services, forestry, food and agriculture, microfinance, which was in many ways a precursor of impact investing, housing. But healthcare is up there. Healthcare is one of the areas that impact investors are very, very interested in. So that is good news. The thing is to find the impact investors that are investing in healthcare and that are also interested in the kind of healthcare projects that you're trying to fund and in the geographies that you're trying to fund. So it's not just finding the type of investor, it's finding the specific impact investor or venture philanthropist that is going to be interested in the type of thing that you have. So there really is homework that you all need to do as you're thinking about the kind of investor that you would need to bring around the table to fund the project that you're working on. Next slide. So if we look at the types of financing instruments that impact investors are using, the main one is private debt, which means they're giving loans to these social purpose organizations. So that's a very simple instrument. And I should just say, we're going to look at a lot of instruments that have fancy names, but investors prefer simple, straightforward instruments. The more complex something is, the less interested they're going to be, because complexity does not mean that it's a better approach. So the more simple, the more clear. Providing loans is very straightforward for many of these impact investors. The second area is publicly traded debt. This would be things like green bonds, sustainability bonds, impact-linked bonds. I'm not going to go into detail on that. I mean, there are more and more of these kind of bonds. Now there are blue bonds, which are focused on water. It would be nice to have healthcare bonds, I think. But anyway, maybe that's for a deep dive at another time. But the third area, and this is the area that most people, when they think of impact investing, they think of this. The third area is private equity. So venture capital type investments. So that is the third most popular area for impact investors. And actually, one of the members of PQMD, J&J, they already, I think 12 years ago, I met Frank, who was the lone pioneer within J&J trying to pilot some work on impact investing. And they had a pilot project on the ground. And I've been in touch with them recently. I was hoping to get them for this webinar, but hopefully we can get them to come another time to talk about the work that they're doing. But now they actually have an impact venture fund, which is investing in impact ventures around the world. So from that pilot many years ago, they've been on a journey in which they've really been able to establish this fund. And I know another great example is Save the Children. And Perry, I see you're online, so I look forward to hearing from you in the Q&A. Anyway, so there has been a lot of progress and success and evidence around impact investing in healthcare, which is great news. So just briefly, I'm going to show 2 slides that I'm not going to talk to. I'll just show them quickly in passing before we move to blended finance. We'll skip that. The next 2. These are just some of the case studies I put in here. They're all healthcare focused. This is Leapfrog Investments. It's one of the early impact investors, very successful. Healthcare is one of the areas they invest in. And so again, you know, it's how do you do your research to find the impact investors or other types of investors that invest in healthcare? What do they invest in? And then trying to get an introduction to them. Next slide is another example. This is more a philanthropy-led impact investment, but we'll move on now because I know time is short. We'll move on to blended finance. So blended finance, and again, when I was at OECD, I was working side by side with my colleagues that were leading the work on blended finance. A lot of talk about it. A lot of talk about blending is trending. It needs to trend a little bit more. It is a very important approach. It's a way of blending and mixing concessional capital with commercial capital. So the purpose of blended finance is to de-risk the private investor. So it's to get philanthropic money, government money as concessional money, and then to build a structure. It could be a special purpose vehicle, or it could be a more simple structure that will de-risk and allow mainstream investors to come in and still get their returns, and the concessional capital will take more of the risk of the investment. So a very important approach because it allows you to bring in mainstream, which means usually larger chunks of finance into a project or a structure or a deal with this concessional capital. So here again, I have an example on the next slide, which is actually the Gates Foundation, JP Morgan, DFIs, so Global Health Investment Fund. So you can see some more information here. Again, I'm not going to take the time to go into all the examples because I have many in the deck. But blended finance plays a very important role, but it's finding the right partners and structuring the blended finance in a way that can attract the kind of commercial capital that's intended. So if we go to the next slide, I wanted to move, and I'm really giving you a fast tour of a set of instruments. And again, in New York or in other venues, we can do a deeper dive in some of these areas. But I just wanted to make you familiar with the kinds of things that are out there and give you a little bit more information about them. So the next one is results-based financing, which goes by many names. It goes by outcome-based finance. It goes by pay for success, many names, just to confuse everybody who's not in the market. So apologies for that. But basically, it's about contracting for outcomes. So there are things called social impact bonds, development impact bonds, many other instruments that fall under this category of contracting for outcomes. Social impact bonds and development impact bonds actually are not bonds. They're not bonds like green bonds and sustainability bonds, and which are normal bonds, financing instruments, debt instruments. These are contractual arrangements between a commissioner of outcomes, like a government, for example, and investors and service providers on the ground that are trying to achieve these outcomes, these health outcomes or environmental outcomes on the ground. So it's a structured contract in which payment for the outcomes is embedded into the contract. So it creates positive incentives for all parties, for the service providers to do a great job delivering effective, efficient outcomes, for the investors to make sure the service providers are doing that, and for the commissioner, they're able to save costs, and out of that saved costs, they can actually pay a return to the investors if everything is working well. So there are a lot of examples of these. I have a few of them in the deck. I have one on the next slide, which I won't talk to in detail. But this is one of the results-based funding instruments put together by the World Bank, the Global Fund, and it's focused on Rwanda. Again, all of these are healthcare examples, just to give you a sense of the kinds of things that have been done already, and perhaps stretch your thinking about what you all could be thinking about in terms of financing for the kind of projects that you're involved in. I have more outcome-based financing examples a little bit later that I'll show you. So if we move to the next segment, it's about demand-side approaches. Those of you who were in London at the Global Health Policy Forum, you would have heard that great dialogue we were able to have with the founder of MedAccess. I mean, that is an excellent example of demand-side approaches. There are many different demand-side approaches, but what's really great about this is that it's providing direct financial incentives or subsidies to beneficiaries on the ground. So it's actually changing the market dynamic. So it's not just trying to find a way to de-risk an investor, it's actually changing the whole business model around. So again, we heard from MedAccess in London. I have an example on the next slide if we go to that. So this is an example looking at the use of cash transfers to women. So it's just one of the kind of demand side cases. There are many kind of demand side approaches. So I think this is where a lot of the future innovation is going to come. Because as we discussed also in London, the world has changed, the context has changed so much, and particularly in this sector. And so it's about really rethinking the business models on the ground and how to do things differently. The issue is not the money. Money is there, and money can be attracted through these different approaches. But what's important is really that innovation on the ground. And again, several people talked about that in London. So if we move to the next slide, I'll talk a little bit about catalytic capital. This is very important because often these ventures, when they're getting started, they haven't yet proved themselves. So perhaps an impact investor or maybe even a social investor isn't yet ready to come in. There's too much risk and not enough clarity on what kind of return might come. And so this is where philanthropic and government catalytic capital can make a huge difference, providing some first loss capital, guarantees, concessional loans, it's a tongue twister, convertible grants, or technical assistance facilities. So again, with catalytic capital, there are a lot of approaches that can be applied. And I can say, having looked at many examples and case studies during my work on impact investing at the OECD, often catalytic capital is needed for ventures focused on social, environmental development, especially in the developing market context. Usually catalytic capital is needed. So again, there's not only one type of investor that's going to come in and support the great work you all are doing. You probably are going to need different types of capital and different types of investors throughout the duration of that project. But at the early stage, often this catalytic capital plays a really important role before the other kinds of financing can come in. So if we go to the next slide, there's an example here, the Global Innovation Fund. I don't know where it stands at the moment, but anyway, again, you can look at these in more detail later. So if we move to the next slide. So other financing instruments, innovative financing instruments. So a lot of things fall under this umbrella. We've already talked about some of these. There are other things here as well. I don't want to go into them in detail because I don't want to make it more confusing than it might seem. But I wanted to emphasize a couple of things. One is there is a lot of value added for applying innovative finance. But, and I'm going to say this later, but actually I'll just say it now. Those that know me know I say this all the time. With innovative finance, the innovation is not in the financing mechanism. The innovation is in that solution on the ground, in the innovation of what the project is doing on the ground. That's what's going to attract the investors. If there's actually more efficiency in the way things are being done, if there's more innovation, if there are different kinds of partnerships, if there's really good data and measurement, if there's some sort of risk sharing and opportunity to scale up the project from pilot to a broader scale, these are the kind of things that are going to interest the investors. So if we go to the next slide, I have two examples here of innovative financing instrument. This is an example, Gavi. I think you all know Gavi. You all know the IFM bonds, the Gavi bonds, as they're called. This has really been a poster child in the innovative financing field. I've worked with a lot of international organizations. Being based in Geneva, I've had the opportunity, the privilege to do that. And a number of these international organizations have been looking to implement innovative financing instruments, and many of them start by looking at what Gavi has done. It's amazing what they've done. It's not easy to put these kind of things in place. It takes a lot of planning and forethought, but they've done a really incredible job, and there are a lot of lessons learned from what they've done and from what others have done. And I think a lot of players in this market that have innovated and been some of the early players in innovative finance, they luckily have been sharing a lot of their lessons learned. So there is further information that you can find about these things. Once you figured out which of the kinds of financing instruments, which of the kind of investors you're interested in, you can start putting these pieces together. If you go to the next slide, I have another example. This is a traditional DIB, Development Impact Bond, which is not a bond. It's a contracting for outcomes instrument. But this is one you can take a look at again in more detail afterwards. So if we go to the next slide. So as I mentioned before, often financing global health requires this whole continuum of capital. It requires the grants and philanthropy. It requires the catalytic capital. At some point, probably some blended finance structure. Maybe at some point, some outcome-based contracting. It's not necessarily in this order, but usually there are pieces of this that are needed. And to give you all hope, when I did those case studies at OECD, I was really surprised at how early not just the impact investors, but the mainstream commercial investors would come into these deals and invest in the projects, especially after there had been a little bit of catalytic capital, which brings not only the money, it also brings the brand, it brings the credibility, and it makes other investors comfortable to come in if they know, for example, that Gates Foundation has provided some catalytic capital, or Rockefeller Foundation, or the whichever government. It provides assurance to the impact and the commercial investors to come in. So there's no silver bullet. There's no one type of investor. There's no one type of instrument. You really will have to think about this whole continuum of capital. And, again, I just point to other organizations that have been on this journey. And it is a journey. It's a learning journey. It's a piloting journey. But as you move along and start getting familiar with using some of these instruments, a lot of new opportunities open up. So if we move to the next slide, just a couple of things on misperceptions. people do think that impact investors are willing to sacrifice returns. Again, please remember that spectrum of capital I showed you, where I broke out the social investors from the impact investors. One of the slides I skipped is the return expectations that mainstream impact investors expect. They do want a risk-adjusted rate of return, so they're only going to be willing to come in to your project once it's at a stage that they're able to get that. So, just keep that in mind. Don't be fooled by the impact label. Don't be fooled by any label. Investors are not fooled by the impact finance, the innovative finance label that I mentioned earlier. There is this perception that if you call it innovative finance, the investors are going to come running with their open checkbooks. Doesn't work like that. And so let's go to the next slide, because the positive side of this is much better. So there is growing evidence that there can be competitive returns in health impact funds. I think J&J is a good example of that, but also many examples I have in the deck, and many more that don't fit in the deck. So that's good news. The private sector interest is really rising, particularly in digital health and health tech, but there are a lot of areas that investors are interested in. But you also have all those you have the venture philanthropists, the social investors, philanthropy. And this point about innovation, the innovation is not meant to be in the financing instrument itself. As mentioned before, the more complex the financing instrument is, the less interested an investor is going to be. So you want to keep the financial instrument crisp, clear, straightforward as possible, and make sure there's innovation, efficiency, effectiveness in the way the solution is implemented and in how things are structured in terms of the expected outcomes, and that there's greater efficiency and greater effectiveness. Next slide. So what's important as well is not just identifying the funders, but as you all know, it's about building trust with these funders. First of all, it's important to approach them as long-term partners, not just as funders. They have a lot to bring to the table in terms of their own experience and their networks. So it's not just about the money. And a lot of people forget that, particularly when they're approaching foundations. I used to work at a foundation, and we saw this. You can smell a mile away when people are chasing you for the money. You want to find the ones that understand that you're a good partner, you're going to collaborate, you're going to bring your network, you're going to bring your experience, and not just the money, but then they're willing to also work with you, partner with you, and provide money. You also need to make sure that your impact goals are aligned. You don't want your investor to come in and push you away from your core mission, because that's not good. You need to find the mission-aligned investors that are going to come in and work with you. You also need to be able to measure and report on the impact that you're having. This does not mean measuring everything that moves. My former boss at the OECD used to say, measure what you treasure, don't treasure what you measure. You don't need 100 pages of numbers. That's not useful for anybody. What you need to do is identify the most important few metrics that are going to help you make better decisions about capital allocation and how you're doing on the project. So it's not about less is more with the metrics. And then finally, it's important that you show funders some of the great work that you've done so far, and just help them feel comfortable with the kind of partners you've worked with and the experiences that you've had and what you've done before. So next slide, and I'm reaching the end and the best part, which is going to be the Q&A. So some of the lessons learned, what works and what hasn't worked, and this is where I already will then open up to the Q&A. We see that these blended finance models, leveraging public and private partnerships, can really work. They can take some time to structure, and you have to make sure that the incentives are aligned, as I mentioned earlier, between the funders and the project implementers, and that can be tricky, but very, very important. Also, what works is making sure there are very clear outcome frameworks with measurable impact, and again, very focused on the impact that matters. the impact that's important for your project, for your initiatives, but also for the beneficiaries on the ground. What's really delivering that impact, and not just what you think sounds like great impact. So understanding the beneficiaries, having that stakeholder voice involved upfront is very important. I didn't have time to get into that too much, but that's very, very important. And also engaging early with the investor. Investors want to be part of the project design. You know, you can come with the most beautiful thing, but if they don't have any skin in the game, they weren't part of it, they might be less interested or less committed long-term to being part of it. So some of the other things that don't work, I already talked about incentives, but also having these overly complex financing structures. So don't be too innovative about the financing mechanism. Don't focus on the solution. I've already said that a number of times. And also, you know, what's very tricky, and I know this is an issue for many organizations, you have short-term funding cycles, but you're trying to fund long-term problems. So how do you manage that? So with that, I wanted to open up to the Q&A. We still have some hopefully good time to go through that, and I look forward to hearing from all of you. Well, all of you maybe it's not going to work, but eventually all of you, but some of you. So I don't know, Victoria, will you or EJ moderate the Q&A?
Yeah, we have asked people to enter their questions in the chat, but I think since we do have 10 minutes, if somebody would like to come off mute and ask their question, I think that's good. And Perry has her hand raised. So Perry, you are first up if you wanted to come off mute and ask your question or make your comments.
Yeah, mostly. Can you hear me? Mostly,
Yes.
I just wanted to say, Karen, you're singing our song. And this is exactly the experience that we've had at Save the Children Global Ventures. We're using all of those models that you talked about. We are seeing increased donor interest in them. And then I think your cautions are also exactly right. So the only one that wasn't on your list that we're also doing is leveraging carbon finance in order to fund development. But otherwise, I'm so glad this is recorded because I'm going to share it widely within Save the Children.
And can I just ask you while you're here, while you're off mute, what was the time frame? Because this is a journey, as I mentioned, and J&J got started quite a while ago, but now they have a really vibrant program, and same with Save the Children. But when did it all get started? Because it does take some time to put things in place.
It absolutely does. So our very first impact fund was in Australia, started in 2019, and very small though, 5 to 7 million. And that one was kind of the impetus. Then we began to look at venture philanthropy, other impact, like actual market rate impact return, so true impact funds. We've added carbon finance maybe 2 years ago. And what I would say to you is all of this, you know, we had one person where we closed a deal within 2 weeks, right? It was 2 weeks from the first conversation to the end. And that happened last month. But that was based on honestly, the trust of the brand, the fact that we have such a known presence on the ground. That's a huge asset when you're trying to do this, because as you say, it's that innovative delivery model that is really interesting for most people, because what they want is impact. If they're coming to Save the Children Global Ventures and not Morgan Stanley or Fidelity, whatever, it's because they're really interested in the impact. So how you can express what you can do with their money is the most important thing, not the actual mechanism per se. So It's been 5 years, and I would tell anybody it's a minimum of 5 years because we're finally at the tipping point, I think.
Yeah, and probably it was another 5 years before that to get the buy-in, even to have the fund in Australia, or at least a few years. But thank you so much for that. That's very helpful. And so, you know, the good news is once you get started on this, you can progress and get to a point where you have a portfolio of different types of financing approaches. And all of you, I mean, most of you on this call, your organizations have great brands. And for a number of your organizations, you also have presence on the ground. So I think there's really a lot of opportunity. David?
Yes, thank you for the presentation. It's amazing to hear that, first of all, the portfolio and the investment is growing for all of the needs that we face every day. But I have a question regarding what you mentioned when it comes to the blended finance as a model to follow. What has been your kind of experience in the healthcare system per se, which by definition is complex, to simplify the blended articulation between private and public sector, plus particular interest in the healthcare system, that you have so many stakeholders with different very targeted interests, and having this kind of a commonality of investments for a bigger challenges or bigger changes or impact is not that easy. So any recommendation from the case studies that you shared, something pragmatic that we can pick up right now, would be very useful. Thank you very much.
Yeah, thank you. So I have not been directly involved in a blended finance healthcare deal. But I think in any blended finance structure, what's really important is having a clear focus on what it's funding. So it's not that you're funding the whole healthcare system in a particular region or town or country, but it's trying to focus on something that's investable, bringing in that concessional capital to help de-risk the commercial investors that you want to have come in. You know, a lot of commercial investors, it's not just about the real risk, it's also about the perceived risk. They might not understand a certain developing country context, and they think the risk is higher than it is. Or maybe they don't understand infrastructure or, you know, building a hospital or whatever it is, and they think the risk is higher than it is. So that's why, you know, having these players, philanthropists or governments, and those that really understand to do that de-risking at the front to help bring this capital market, the commercial money in. Because at the end of the day, they understand infrastructure investment. You know, they understand certain things. And if a blended structure around a very particular type of investment, again, the more focused, the simpler the structure is, the better. If you try to put too much into it, no one understands what the expectations are. And that's a dangerous deal. So it needs to be as clean as possible, as clear as possible, as focused as possible.
Excellent, Karen. Thank you very much. Very useful.
I also wanted to encourage Brian Gower. Thank you so much for entering your question in the chat, but I don't want to just read it. If you wouldn't mind coming off and just asking it directly, if you're still there, that'd be great.
Right, thank you. Yeah, I just had mentioned, Karen, that at least for Project Hope, this is an area that I just recently, we all came away from a recent gathering and talking about new approaches to financing models and how we can adapt our strategies, especially in the current climate that we're in with a lot of the USAID funding going away. I think what you're emphasizing is ringing true to some of the buzzwords I've been hearing from partners like the Gates Foundation or Rockefeller or others when they're talking about catalytic funding. And I'm just thinking, again, pragmatically, like what David was talking about, within the healthcare space, one of your slides gave me some hope in regards to that's a sector that there is strong interest in, but just, and maybe SAVE has already been doing this, but specific examples of where it's not necessarily developing big, complex initiatives around each of the different ones, but being able to easily pivot as you're talking to investors. And again, I was just trying to think about, you know, the specific audience. Are we talking about your high net worth individuals? We're talking about corporations, we're talking about foundations, or is it just kind of cover the whole gamut? So again, as someone that's just seeking to learn more. I was just really curious to kind of dive in more on the pragmatic issues as well. Thanks.
If you
So
want me to say, I was just going to say, for us to Save the Children, it's all of the finance. We do all across P&P and institutional. Yep.
Great. And I was just going to say that you mentioned a number of foundations. Actually, foundations have been the leaders in the impact investing space, in the whole impact finance space. Rockefeller actually hosted the meeting that led to the term impact investing. That was in Bellagio at the Rockefeller Center in 2007. But they all have been, they've really done a lot of capacity building of this market. So not only are they investors in these ventures, but they've also helped to build this market because they understand how important that market is. And to have this spectrum of capital that can come in and play different roles at different times in these really important ventures on the ground.
Great.
Yes,
Kavita.
Hi, Karen. It's great to see you. Thank you for the presentation and joining us. I have a question. Last week, we were together at the PQMD Membership and Learning Forum, and one of our colleagues mentioned to me the growing interest in sustainability-linked bonds tied to ESG outcomes. So I was curious if you could share where you see that fitting into these current vehicles. Is it just another name for one of the existing ones, and how you see that growing?
So these bonds, green bonds, sustainability linked bonds, they're really bonds. So these are not the, I know it's super confusing, but these are not the social impact bonds, development, those are outcome contracts. But these are real bonds that are issued by governments, issued by companies, and they have earmarked part of that, either all or part of that capital for green projects, water projects, healthcare projects, whatever that might be. This is a really popular area. I do have a slide on the growth of the market. I didn't put it in because it was starting to get too much into very specific types of instruments, but I'm happy to share that. So there has been a growth. Green bonds have been the most popular. And there are standards around green bonds developed by ICMA a number of years ago because people went a bit crazy and said, okay, we're going to do a green bond. And there wasn't a lot of green in that bond. So now for green bonds, sustainability bonds, and also for sustainability linked bonds, there are now ICMA standards around what are the criteria to make sure they meet those requirements. I would say investors are still a little bit nervous about sustainability linked bonds, because what is that link? And it starts getting weak, and how are those standards applied? But this is an area, blue bonds are becoming more and more popular, focused on water. TNC, the Nature Conservancy, has done a big blue bond in partnership with others. That would have been a good example also to put in. I was trying to focus on healthcare though. So anyway, the answer is yes. I think there is a lot of opportunity in sustainability linked bonds, also potentially in sustainability bonds. But that's an instrument investors understand well. It's also an instrument that investors really like, mainstream investors, because they can put a lot of money to work in these instruments. So that is an area where money can move. Another area where money moves is in the public equity markets, where investors are choosing to invest in good companies like the ones that many of you are working at. I think we're getting to time, and I know that we have some other things to do. So Victoria, let me know.
I think we have one last question. Actually, EJ, are you sure you don't want to come off mute, or do you want me to just read your question?
Yeah, I'm happy
Is
to come
she
off.
allowed?
I'm allowed to come off mute. I know. I get asked that question often during the day. So I was just wondering, we've heard over the course of our meetings and such from organizations that do have these investment funds, and you have like these 6 different categories. And, there's intermittent interest in organizations that want to pursue it. I think you hit it out of the park right in the beginning when you said, people look at this as kind of an all-encompassing solution, but then when they dive into it, they recognize the amount of work and effort that's required to actually get it to be impactful, and not to mention the timeline that's required. So I'm just wondering if you might advise the group a little bit about what kind of skills and human resources do organizations need to make sure they have on board in order to pursue these? Do they need special technical skills? Is there, we've met a whole range of different experts who are working in this area. So I just wonder if you might comment on that.
Great question, of course. I think that it's important to have somebody who is savvy in finance, obviously, and this can be someone who's brought in to help think about and structure. But you also need that sort of core person, but you also need the top down. There needs to be a commitment from the top. I did some work with ICRC a number of years ago. They were the first ones to issue a humanitarian impact bond, which is not a bond, it's an outcome contract. In fact, I think they're the only ones. And that was really driven both by the top down, by the head of the organization at that time, but also they had the right person in the organization that was very passionate about it. And then over time, they built a team around. But I think start with, first of all, the commitment to go in this direction, which needs to come from the top, and then find the right person that can help pull the pieces together. And that person has to be good at working across the organization, because there's a lot of buy-in that has to be built, because people, this is new for people. And when something's new, people tend to distrust or get a bit nervous. So it needs to be the right kind of personality. So not necessarily some financial genius, but someone that's familiar enough, but has good interpersonal skills that can make people feel comfortable and help get them started and bring them along this journey.
Yeah, thank you. Thank you very much. That's incredibly helpful. And I just want to, I know we're at the end of our time, so I just want to really thank you for, I think everybody here can see why you were so successful in London and why we're so excited to have you not only on our advisory board, but also willing to continue to educate our community about these kinds of things, because you're so able to put this really complicated language into or complicated concepts into really accessible language, and talking about the continuum of capital. And so many of the things you said actually don't only apply to finance in general, but apply to, just sort of how we communicate our projects and how we communicate with people who we want to either join us as partners, but also, of course, invest in the work that we're doing. So thank you so very much. Before everybody goes, I just want to mention that we have a couple of questions that we're going to put up that we would love for you to, they're going to pop onto your screen. One of them, as we mentioned, we are going to be doing a finance workshop in New York in April. And so if you have any thoughts or comments about what you'd like to see there, just off the top of your head, we'll be working on it. And probably asking you for additional comments over time. So if you could do that. And then one, of course, about the Pillar Talk. Again, is please put on your calendar. I saw that it came across on the chat that our Global Health Policy Forum will be in New York City, April 28th through 30. The special workshop will likely be on the 27th, in case you're blocking your calendar. And there will be actually a couple of workshops on that day, so you might want to just plan on being there. And your feedback will really help us shape not only the sessions there, but also shape our future Pillar Talks. Thank you again, Karen, very much appreciated your continued support of PQMD and the incredible expertise that you bring to us. And for all of you who are participating, I hope we'll see you at the next Pillar Talk, and keep your eyes out for the topics and discussions that we will be having going forward. So, and hopefully see you in New York next spring. So until then, take care, stay connected. Bye, everybody.